So we have old highs in here. If you look at the high here, it comes in at 39.33 1/4. I mentioned that level today, mentioned it a few times, said we were going to trade up to that. And I built the idea that looking at price, studying it in the way that I teach it, it would be very easy to fall victim in this type of trading day, where it's choppy, it's listless trading back and forth, and how to anticipate it, what to look for. And I want to go into the 5-minute chart real quick. Okay, and here's the 5-minute chart, and we're going to add some annotations here. So here is the 39.33 1/4 level. That's why that level was mentioned in the tweets. This is the low at 38.72 1/4, and the old low on the daily chart that did not get traded through is at 38.55. And notice we just fell short of reaching that at 38.56. So we went one handle short of that, started trading higher. And I mentioned how the market many times can present opportunities that look like it's likely to form a setup, but it really doesn't really come to fruition. And if you look at the range here, okay, I'm highlighting this fair value gap right there. Okay, how we traded up into it, started working lower, created a small little fair value gap in here, bumped into that, traded lower, nothing really in here to work with in terms of the model. So nothing here is a short. We were talking about all of that this morning. So as the market was trading around in this area, I mentioned how it was likely to be a 50-50 probability. That means it's likely to go higher just as well as it is likely to trade lower. Okay, so what's the benefit in that? Obviously, anybody can come into it with a 50-50 expectation, but it really statistically moves to 50-50 when we start trading back into the middle of the range. Okay, so this imbalance here, the fair value gap, it should have offered a little bit more movement lower. Why wouldn't it go down and take out this short-term low? It went below this short-term low here and then started rallying, working towards the relative equal highs over here. I mentioned early on that it would go to 39.33 1/4. That's where it would go. But I favored, in other words, in terms of bias for the longer term, I favored the 38.55 level down here for sell side. I don't think that they're done with it down there, but we have to take every single trade idea based on its current dealing ranges. And what's a dealing range? Well, a dealing range would be like from this high down to that low, and we measure those. Yes, it trades up into that imbalance and trades down to a short-term low. That's a tradable opportunity there, but it's not very clear after that. It just goes back and forth, chopping. Short-term lows are taken, high is taken here. We trade back and forth. All of this is really ugly type of price action. And I mentioned that we would go to 39.33 1/4 back here, and it ran right up into it, cleared those relative equal highs, broke down, traded back down into the range. And I started talking about how the real setup that would be formed by my content, by the things that make sense, and the algorithm would deliver a specific framework today. I told everybody on Twitter, you can go back and look at it, to take a vertical line and add it to 3 o'clock New York local time and 4 o'clock. And that would be the setup that forms to take us back down into the middle of the range. Now, I tell everyone in the tweets to study the middle of the daily range. Okay, so what does that mean? If you look at what the high was and the low, okay, right in here, that's the middle of the range. We ran above the short-term high, so we had relative equal highs here and relative equal highs here. So there's buy side resting here. I outlined how the market would use the running up to take out the buy stops, to squeeze anybody that was short and trail their stop loss down, and also to induce people into thinking it's going to go higher. So that way it builds up liquidity below these lows. What kind of liquidity? Sell side liquidity, because they're going to protect their long positions. But the main thing was focusing on the middle of the range here. So if we're looking for setups that are going to be based on a run above for buy side and pull back into the range, it needs to be specific in terms of time. I gave a very specific window between 3 o'clock and 4 o'clock in the afternoon. So we go into an hour, I'm sorry, not an hour chart. We're going to go into a minute chart. Okay, and you can see here, the market rallies above, bumps into the buy side liquidity. Smart money uses that to go short. This is exactly what I outlined beforehand. It's all in the tweets. It's not ambiguous. It's very specific. I tell you exactly when the trade is going to form. I tell you exactly how it's going to happen. I tell you the framework, the logic, the narrative, everything. And it's going to pull back to the middle of the range. Here is the breakdown. Here, let me take this. Move it here a little bit. Is this a swing low? Yes. Is this a fair value gap? Yes. Does it trade back up into that range? Yes. It works lower, back into the middle of the range. Let me put this back where I want it. Okay, and if I add the annotations, you can see right there, I sold short at 39.40 and 3/4, and I took 4 of them off at 39.08 and 3/4, middle of the range, and you can see there still is a position there with partials taken off already. Okay, and the limit order down here at 38.55. It doesn't matter if it goes down there now, I don't care, but I have a position in play should it do so. And I want everyone to understand that there are people out there, obviously, want to say stupid things because they either want to get a rise out of me or they feel that they're competition and they want to get in a lot more attention for themselves. Honestly, if you want to build attention around yourself, just do things that warrant people's attention placed on you. But for anyone that obviously did not spend time with me today, this is going to be rather boring. It's going to be pointless to you. But I walked through all of the things that days like this, where it's choppy, okay, where it's just going back and forth, this was not read wrong. I purposely took everybody into the marketplace through their own chart and told them to think about what was going on in their own mind, what other traders would be thinking. So that way you could really capture what it feels like to be in there looking for your own setups and try to think critically about it. I outlined in advance where the setup based on the things I teach up here, where it runs the buy stops, we pair with that and then pull back to the middle of the range. And it does so beautifully. All of this in here is really hard, choppy price action. It's very, very difficult to trade in those types of ranges because they can come back on you, stop you out, and just go nowhere for a long period of time. So if you know what you're looking for in terms of what the algorithm is going to do, and the algorithm on days like this is called a consolidation day. And what happens is this. The market starts trading, creates an initial range, and then stays in that range until the afternoon. At 3 o'clock, it used to be the bond close that started this whole thing, but now it's just 3 o'clock to 4 o'clock when equities close, the closing bell. That sets the tone for on-close orders. So what that means is, what was going on prior to 3 o'clock? The market was rallying up. What did it go up for? The buy side liquidity. But traders are going to look at that as a breakout to go higher, and they're going to pair that with the market participants that are considered smart money. So that's exactly what I outlined. This is exactly what transpired. Everybody in the Twitter feed were following along. I mean, granted, there were a few people, and you can go through and see who they were. They weren't really paying attention because they came into the conversation late, and I went a long day today just tweeting.
So for future videos, I'm going to try to be creating a video summary at the end of each video just to explain what I understood from the particular video you all watch. And I'll be starting with this video. Without wasting much time, I'm going to be explaining what I have on my notes here. You can, if you can listen closely, you hear the sound of my notes. Whenever I am studying ICT concept, I always have my notes with me, and the reason is just simple, just to jot down the keywords. So I'll advise you do the same. You should just watch and study, not just Netflix ICT concept. So the first thing we discussed in this particular video, based on my understanding from what ICT was just doing, is his concept of liquidity. He went further by giving us introduction to his internal range liquidity. That was when it took the range high and the high of this to the low of this, the 50% of it. That is what ICT termed as his internal range liquidity. Any fair value gap that is above the 50% of a range is termed as internal range liquidity. So this red rectangle here is an internal range liquidity. So below the 50% also, whenever you're having any fair value gap, it might serve as an internal range liquidity. So above the 50% of price here is what ICT call premium level. Then below the 50% of this is the discount level of price. So from my understanding in this particular video series of ICT, what ICT was just explaining to us is that whenever we can define liquidity at both sides of the market, that is the buy side and the sell side liquidity, always avoid that trading section. For example, let's say you enter the market at 9:30 and you're having liquidity, you have a narrative that support price going for buy side liquidity and support price going for sell side liquidity. Avoid that particular trading section. That is just what he was trying to explain. And now you might be asking me that then when is the best time to trade? Maybe you can just look further for the next section, which is going to be the PM section of that particular day. You can just look further. Whenever price breaks above the buy side or the sell side, that is when you should start looking for setup to trade against the opposing liquidity, just the way he showed us in the video, by shorting when price went above this particular buy side liquidity. And this is not just a random shorting area. If you notice, ICT went short at a particular trading time, that is a 3 p.m. to 4 p.m. trading time. If you have been studying his concepts, you understand what this particular time means. Don't forget to always set your time on TradingView to the New York time. He have been emphasizing on this in his videos. So this 3 p.m. to 4 p.m., ICT believe there is an algorithm that always take price to pools of liquidity at this particular time. And I'll be going further by showing you chart example. Now you might ask me if I believe that. Yes, I've been trading ICT concepts for more than 4 years now, and I feel convinced that yes, this particular market is controlled by an algorithm. On a random day, if you should, and random time, if you should enter the market shorting highs like this, you might say that it will go against you and you might encounter a losing trade. But whenever you short highs at particular trading time of ICT concepts, you see that it will go in your direction. Although it tends to fail sometimes, but majority of times it's a win. So that is just it. So whenever you're having equal highs like this, liquidity is resting above it, and whenever you're having equal lows like this, liquidity is resting below it. Now I'll be showing you some examples of on the chart right now on liquidity areas. Sorry about that. So let's go. So if you look closely, I have this rectangle that marks this particular area here. Now we just discussed that whenever we are having equal highs, it can be like three highs. I just call them equals. That is just it. They are equals. Look at this high, and this high. They are equals. So whenever you're having that type of high, there's liquidity above it. So when price should go above that particular highs, smart money is going to do what? It's going to short above this particular level here. And the reason is simple. Why? Because retail traders, whenever price breaks above these levels like this, they tend to what? Do what? Buy they tend to keep buying, believing that this is a bullish breakout and to keep buying, which will later turn against them and go against their direction. So this is another example in a bullish environment. Look at how price went below this particular sell side liquidity and immediately what it reversed and went higher. This is what equal lows. Price went below equal lows here and reversed higher. Same thing here. Price went above relatively equal highs, then it reversed for sell side liquidity. That is just what ICT was teaching using its concept of liquidity. So I'm going to be showing you another example using the 3 p.m. to 4 p.m. macro. Now you should look closely. Last week, Friday, we had a similar example here from what ICT have been teaching in its concepts. That is our 3 p.m. candle here. So what we have discussed so far is that price at this particular level is going to run to pools of liquidity, then reverse and go in the direction where there is another level of liquidity. So at 3 p.m. price opened, ran this particular sell side liquidity here that is resting below this low. Immediately price took out the sell side liquidity that is resting. I marked it using this blue color. Look at what price did. It rejected the low and went higher, creating this fair value gap and this other block here. This is a fair value gap and we're having an order block here. Notice how price created a shift in market structure just above this candle here. If you look closely, we took out that candle high. We took out this particular candle high. Although it was shallow, but we ran that particular high. So price returned into this, just a little retracement, and the reason it was just retracing was just to tap this order block and this fair value gap. So you can buy from this fair value gap and target the next level of liquidity, which is going to be the liquidity resting above these highs here. So look at our price. This is just what ICT explained in that particular video.